Hello again. This is Andy Michael with Seven Springs Wealth Group. Today we're going to talk about the Series I savings bond as part of our outcome focus series. At Seven Springs Wealth Group, we build outcome focused portfolios that are clearly defined, invested with purpose, and measured for success. The three outcomes we're focusing on are preservation, good income generation, and compounding growth over the long run. So today we want to unpack a little bit deeper into that preservation bucket and talk about a tool in the toolbox, the Series I savings bond. This bond offers principal protection that's backed by the full faith and credit of the United States, and it also offers compelling return, which is an inflation-adjusted rate, which helps them maintain purchasing power. The trade-off for that is liquidity. Let's talk about the interest first. Series I savings bond pays a fixed rate and a variable rate of interest. Today that fixed rate is 0, but the variable rate is quite interesting. With inflation so high, it's currently paying a 7.12% annualized inflation rate, a variable interest rate. Now let's look at this compared to recent norms. We can see at 3.56% over the next 6 months. That is very, very high compared to the 6-month rate looking back over the past several years. And when we think about going forward, we looked at last week, looking at 10-year rates being in the 2.5% to 3% for inflation. That's what the market's suggesting at this point. So we don't necessarily expect that high of a level of interest rate to continue on in the future as inflation at some point moderates. But nonetheless, it's still very, very compelling today. That interest is earned each month and is compounded semi-annually. So that means the interest goes back into the principal and the principal balance of the bond grows. And if there is deflation, like in 2015 here, the interest rate is capped at 0. So you don't have negative interest with inflation, it just stops at 0. If we look at the term of the bonds, they're 30-year bonds and they're eligible to be cashed out after 1 year. So you have to hold this for 12 months. Don't have access for those first 12 months. If it's cashed out between a year and 5 years, the previous 3 months' interest is lost. Let's look at the amount in taxation. Each individual can save up to $10,000 per year into a Series I savings bond. They can be gifted, and that gift amount follows the Social Security number. So you can gift more than $10,000, but the recipient that holds the bond can only have up to $10,000 per year. They are subject to federal income tax. They are exempt from state and local tax. You have two options when you report the interest. You can either defer until the I bond is cashed out and pay all of the interest at once, or you can pay the interest each year as you go. So let's just look at a hypothetical example. Let's say there's a married couple. They can each save $10,000 per year to build up $20,000 per year into Series I savings bonds. If they do this for 10 years, the end result would be they'd have a $200,000 bucket of Series I savings bonds. They'd have all of that interest have been compounding into the principal value, so that $200,000 would have grown. The first 5 years bonds could be redeemed completely with no penalty. The next 4 years would be redeemable with 3 months interest penalty. So still can get all your principal, have most of your interest minus 3 months, and then that final 10th year would still not be accessible today. So this can be a very powerful tool in the toolbox as a savings vehicle maintaining purchasing power. Let's talk about the trade-offs. The first one, again, the big one is that liquidity. You got to hold it for the first 12 months. So this is not a good first bucket of emergency savings. It's not good for known upcoming expenses in the next 6, 12, or even 18 or 24 months. It adds complexity. This is going to be another account with another institution. This has to be purchased directly from the Treasury Direct. And there's another tax form. The amount is limited that you can do, so you can't go buy $1 million of Series I savings bonds. You are capped at that $10,000. For some folks, adding that complexity, the juice may not be worth the squeeze. It does also guarantee not earning a positive real return. So this is not a good substitute for risk assets because it is attached to inflation. It's going to increase at the rate of inflation. And so for high inflation goals such as education or healthcare, which have been accelerating at an inflation rate higher than the broad-based CPI inflation rate, you may still experience what feels like a negative return by the time you need to access those funds for those costs. Today's I bond interest is greater than a savings account. But what about the future? So for example, in 2018, interest rates were closer to 2.5–3% on savings accounts, and inflation wasn't that high. So what that meant was a bank account's interest rate, savings rate, was actually higher at that time than a Series I savings bond. So it is higher today, much, much higher at 7% compared to 0, presumably at a bank account. But that may not always be the case, especially if we think about this term of the bond being 30 years. If this does sound like something that's interesting to you, the way to access a Series I savings bond, and the only way to access a Series I savings bond, is to open an account at treasurydirect.gov. There's the link to the website. You'll set up an account with the Treasury Direct first. You'll have an account number. You'll have a passcode. Once that's set up, it's very simple and straightforward. There's steps directly on the website. Then you can go and purchase your Series I savings bonds, and that would be for each individual that's interested in purchasing Series I savings bonds. So that's it for today. I hope that provides a little bit of education around the great tool in the toolbox, the Series I savings bonds. If you have any other questions, please reach out to us, and we look forward to connecting again soon.